Hello, good day to you. It's me, Andy, and top of the press today is a little quick story that I really don't know a lot about, but you may well be aware of this. It's this new financial system that's coming in eventually. So you've probably heard of QFS and CBDCs and things like that, and all the other things that are going on, including the current SWIFT system, which is crashing, or soon will be crashed. But we have this game changer, apparently. It's not only for banks, but also for corporates when it comes to financing. This is Basel, or Basel, whichever way, wherever you're from. Basel 4, 1V, so for Basel 4. It's coming. This is basically an article that's telling you all about global bank capital requirements. So Basel 4 is coming. So this is all about the banking system that we will probably have eventually when it comes in. There is some talk about this happening towards the end of March. What with the QFS system, banking system, that's the alternative that is currently running in parallel. And if you watch Gisara videos, you'll know that this system is better because it's backed by something, either that's gold or it's diamonds or it's oil. It's actually a system of finance that is backed up by something else, as it used to be. So it used to be gold, and of course when the new system took over, they stopped doing it with any form of backing. So it is literally just paper money.
Since the financial crisis, credit institutions have grown a lot stronger. A lot of regulation has been implemented to strengthen the financial stability and consumer protection. Currently, credit institutions hold less capital in reserve when dealing with low-risk loans than when dealing with high-risk loans. It's common sense and good business practice. The proposed Basel IV Capital Floor initiative will put an end to this sensible link between risk and capital holdings and is a threat to growth and job creation and potentially to financial stability. When calculating the amount of capital that they need to have on hand to cover the risk associated with their loans, credit institutions use two methods: the standard method and the advanced AIRB method, primarily used by SIFIs, which are the largest players. When using the standard method, the average risk weight associated with a housing loan is 35%, and when credit institutions use the AIRB method, the average risk weight is 15%. That's a difference of 20 percentage points. Now, why is there such a big difference? The AIRB risk weight of 15% is calculated based on the risk of the bank's actual customers. The standard method's 35% is a global one-size-fits-all risk weight, not based on the bank's actual customers. Risk weights are important to credit institutions. They determine the amount of capital the credit institution must keep on hand to cover their loans. The higher the risk weight, the more capital the institution must hold in reserve to protect against losses. In this respect, the output floor is key. The floor means that an AIRB method bank must now hold 72.5% of the standard method. Previously, when the Standard Credit Institute held €100, the AIRB Institute held €50. Now, with the Basel floor, the AIRB Institute must hold €72.5. That compromises the link between risk and capital because the increase in capital does not reflect an increase in risk. This means that an institution with low-risk portfolios must hold capital equivalent to that of an institution with high-risk portfolios. The low-risk institutions' costs associated with loans like mortgages and loans to strong, healthy businesses and households will increase because capital is not free. An increase of both cost and capital that doesn't reflect the low risk of the loans that they provide their customers. By removing the link between risk and capital holdings, Basel IV will have negative consequences for the cost of housing for ordinary families and slow down growth and job creation in Europe. Basel IV will make it much more attractive for credit institutions to deal in high-risk loans than the low-risk loans that help homeowners to finance their homes and local businesses to expand and grow. But there are better solutions. Authorities must continue to work to standardise the framework for using AIRB. By standardising AIRB, the risk weights will better reflect the credit institutions' required capital reserves of their loans. Besides, it's not even necessary. On January 1st, 2018, a backstop equaling 3% of the institute's balance sheet will be introduced. So even institutions with a very low risk portfolio will always have a minimum amount of capital to withstand customer loss. Let us continue the AIRB journey and allow credit institutions to continue to offer sound and healthy mortgages and commercial loans on terms that reflect their low risk, and empower credit institutions to support and nurture growth and employment, instead of obstructing it.
So as I say, I don't really know, but we're obviously living in this in the matrix. The system that we have currently is obviously based on fraud. A lot of it is paper. It's paper money. It's not worth anything. I mean, I've got a bit of paper here. That's the same sort of value, isn't it? It's worthless. But they are saying that these systems are going to be replacing very soon the old ways. And of course, once that happens, we will have control over our own finances. So there we go. That's just a quick story about that. And that's it from me today. Have a good day.